Good afternoon and welcome to the FINTEL PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to CEO Matt Timmins. Good afternoon, sir.
Good afternoon and good afternoon to everyone watching. Thank you for taking the time today to come and view the FINTEL half-year results presentation. My name is Matt Timmins. I'm the joint CEO of FINTEL and I'm joined by my colleague David Thompson, who's the CFO of FINTEL. We're going to cover a number of slides today, 18 slides. The rest is available for you to download later, and all the slides are in the appendix there from the attached presentation. David and I will take about 40 minutes to run through the presentation, which will give you plenty of time for Q&A after, so please submit your questions in the usual way. So first of all, for those of you who are less familiar with FINTEL, we work in the wonderful world of retail financial services, and we believe that this market works incredibly well for consumers. Consumers have access to thousands of different financial products, and these products are created and run by large-scale financial businesses which are well capitalized and well run, and consumers have access to those products at a price which is commensurate with the competitive nature of the market that we all operate in. The difficulty for consumers in many cases is how to choose the right product, so which is the product that is most appropriate or most suitable for their needs. And around 80% of all investment decisions and 80% of all mortgages end up in the hands of a consumer via an intermediary of some description. In the main, those intermediaries are financial advisors, mortgage brokers, wealth managers, aggregators, etc., etc. So the market works well for consumers, access to all these products from well-capitalized manufacturers at a price and value which is really, really good for consumers. The difficulty is for everyone else operating in the market, it's quite a challenging market to work in. So the market is heavily regulated, it's highly fragmented, there's a lack of quality data across the market, and lots of intermediary businesses use numerous fintech solutions to give advice to clients, so no real sort of standardized flow of data and technology, UI and UX, etc. However, all participants in the market have a common and binding need for compliance and regulatory support, for data and technology, and for product comparison and information. And we work right at the center of this market, helping all the participants to do a good job for their clients. And we serve three primary customer sets. We serve product manufacturers, financial intermediaries, and end consumers. And rather than focus on all the individual products and services we offer, at this stage, I think it's probably best to focus on the outcomes that we're looking to deliver. So for intermediaries, our role is to help these intermediaries to do the best job they can for clients and to service those clients as effectively as possible. And we do that in two main ways. So first of all, we provide compliance and regulatory support to financial intermediaries. We've been doing this since 2002, and we run two great support service companies for intermediaries, and they pay a monthly subscription for compliance and regulatory support. In addition to that, we offer top-up and additional products that they can purchase on an ad hoc basis. But in the main, it's compliance and regulatory support delivered for a monthly subscription across our support service businesses. In addition to that, then, we provide intermediaries with technology. And the primary technology solution we provide is a technology solution which helps intermediaries with workflow and financial planning. And that's the De facto Engage product. That product is used by over 8,000 intermediaries, and around £50 billion worth of investment decisions are made via that technology system on an annual basis. So intermediaries use the technology to be able to give compliant advice to their customers. And when they use that technology, they input information and data on the client's demographics. They do attitude to risk, asset allocation, fund selection, tax wrapper selection, and then ultimately end up with a set of solutions for their clients. We then take that data and we look through that data on an aggregated and non-personalized basis to understand and gather insights on what's happening in the market. What are the key trends? What are advisors recommending and why are they recommending those products and solutions? And what are consumers demanding? And what are the filters and sorts that advisors are applying to the advice journey when recommending products to clients? We then take that information and those insights and we help product providers and manufacturers to build out the products of the future. So we help them understand what the market is demanding, what clients are looking for, and we help them understand if they're not winning business, whereabouts they're losing business, where in that advice journey are they being deselected as part of the process. We also then help the product manufacturers to get in front of those intermediaries through a combination of digital and face-to-face marketing services, where large product manufacturers can, through subscription to our distribution as a service product, ensure that they're getting product information in front of those key intermediaries. For consumers, we help consumers make smarter financial decisions. And the primary way in which we do that is by researching and rating over 43,000 financial products in the UK, looking at the underlying componentry of those products and applying a de facto star rating to the products based on the quality of them. And then consumers can access those star ratings either via de facto or through the many different aggregator and price comparison websites that they use to make decisions on things like general insurance products and basic savings products. So the de facto business that we have researches and rates 43,000 financial products. It applies a star rating, which helps consumers make smarter financial decisions. A big addition to the business over the course of the last 18 months has been the acquisitions that we've made, and they are part of a connectivity to be able to provide intermediary businesses with all the technology they need to give advice to clients. So whether you're running a small intermediary business of 3 or 4 advisors or a large scale intermediary business with hundreds of advisors, the processes, the systems, the workflow that you need to go through are largely the same. You need to store client information in a recognized CRM of some description. You need to comply with the FCA rules on consumer duty. You need to be able to demonstrate ongoing learning and development to the regulator through logging hours of CPD. You need to be able to give your clients access to their investments via a portal of some description or a website. And then you need to go through a financial planning journey with the client using financial planning software, looking at pension switching software, assessing in some cases tax advantage products, and then being able to trade those products via a platform of some description. And most intermediaries, in order to complete this jigsaw for their clients, use on average 9 individual pieces of software. We think that that's wholly inefficient and that intermediaries aren't benefiting from what should be an obvious data and workflow amongst all of those systems. So our strategy has been to acquire the market-leading businesses in those fields and to bring them together via two-way API integrations, sharing data, eliminating the need for rekeying, and creating clear efficiencies in the advice journey. So that's been the sort of main thrust of the acquisition journey that we've been on over the last 18 months or so, buying what we consider to be the best individual component parts of that jigsaw in the market, and then knitting them together via two-way API integrations. The advantage we believe in this strategy is that the businesses we've acquired will continue to win business in the way they did before we acquired them, winning client by client, advisor by advisor, and carrying on running their business in a profitable way they have before. But over on top of that, the sort of sum of the parts, if you like, should mean that we are able to go out to large-scale intermediaries to begin with and to sell essentially a connected platform or a one-stop shop in terms of giving advice to clients. So we believe the next part of the journey of our business is in large-scale enterprise sales to large intermediary businesses, creating efficiency and sharing data at the center of those businesses on what's happening underneath. So that's a key part of the strategy of the business and a key part of the growth driver in which we believe will come through over the course of the next couple of years. Another growth driver in the business has been the acquisition of 360. We acquired 360 only a few months ago now, but we've been tracking that business for over 15 years. It's a great business run by a real quality management team. 360 support around 900 advisory businesses with over 10,000 clients. They've been a competitor to our support service business, Simply Biz, for the last 15 years or more. And both businesses work incredibly well together. We've got different client banks, and the 360 business provides quality compliance and regulatory support to its customers and has done for a long period of time. The opportunity for growth here is to allow the 360 membership access to some of the additional services and benefits that Simply Biz members have enjoyed for a long period of time. In doing so, we believe that we can create additional value across 360 and across Fintel as a whole. Finally, the third area of significant growth for our business is in the development of a product we have called Matrix. Matrix is a product that was created by De Facto, and that product has been live in the market for over a decade. We have hundreds of customers using the Matrix product, and essentially the way that product works is if you're a general insurance provider, your product teams will access Matrix in order to understand how your product stacks up against the competition. So it's a database of products that is offered out to manufacturers on a monthly subscription basis, containing all 43,000 financial products that we research and rate, so product providers can compare their products against those of their competition. They can look where they're winning in the market, and they can look at areas in which they're lagging the competition. Currently, that product, Matrix, generates around 2 million a year in revenues from the general insurance market and 1.16 million in revenue from the asset management market. And the product itself contains product information. What we're looking to do with Matrix is to extend that out to provide a number of different data sets, firstly to the GI market, and then in addition to banking and asset management. And the kind of data sets that we're adding into the product will be pricing data, macroeconomic data, weather data, claims history data, all of the data sets that these providers are accessing from other people in, again, disconnected software. Our aim is to bring them into Matrix 360, and to offer that out as an enhanced service to our existing customers and to hopefully some new customers as well. So we intend to increase the revenue significantly from the sale of Matrix 360 products to our existing customers, and to grow that even further through the sale to new customers. We expect over time to continue to develop out this product, and for the revenue line that you see there at 3.16 million to increase significantly, to double or treble over time. In terms of the highlights for the half year 2024, we grew the business by 13% in terms of core revenue growth at a EBITDA margin of 30%. We increased the dividend for the half year by 9%, invested 2 million organically into the growth of Matrix, completed 4 acquisitions as well as an investment, and developed 4 important new partnerships. We were voted 14th best financial service company to work for, up from 22 in 2023. The revenue that we generate comes in terms of very high quality. 65% is SaaS and subscriptions, and the balance of that is repeating revenue from the same customers for the same type of product which repeats annually each year. So the vast majority of revenue within the business is recurring or repeating. We delivered strong underlying operating cash conversion at 101%, and David will go into how that breaks down in a couple of minutes' time. And all of this was underpinned by strong market dynamics. As the regulator increases the level of regulation on intermediary firms and brings in new initiatives like consumer duty, it encourages those intermediaries to outsource compliance and regulatory support to businesses like ours. So we believe that regulation, rather than being a hindrance to our business, is actually a real tailwind that creates demand for our products and services. So in summary for me, for the first half of the year, we delivered a strong financial performance. We invested heavily into the business, completing 4 deals in 2024 in the first half of the year to match the 4 that we completed in 2023. So in the last 18 months, we've completed 8 transactions plus 2 minority investments into really strong technology businesses. We've significantly enhanced the proposition, allowing us now to provide all services out to intermediary firms in the form of one connected platform. And we've also increased the proposition enhancement of Matrix to Matrix 360. We believe that we're operating in an attractive market landscape, which has got some really strong tailwinds, and that those are set to continue into the future. So summary is a good financial performance in the first half of the year, really strong strategic acquisitions that embed the services that we offer to our intermediaries and give us the opportunity to go out and enterprise sell to large intermediary businesses. With that, I'll hand over to David, who will take you through the financials for the first half of the year. Thank you, David.
Thanks, Matt, and afternoon, everyone. So as you've just heard, we've been on a real period of strategic execution, and we've acquired 8 businesses and invested in 2 others to build what is essentially all parts of a vertically integrated supply chain. So we stand here with essentially 9 sub-businesses within a business, each of which have got their own underlying KPIs, and we're all over driving financial performance across each of those. But for investors, at a snapshot, we like to boil the business down into 3 key areas that we focus on. And that's core revenue growth, and you can see they're up 13%. But equally, you've got to grow profitably. So the next one is EBITDA growth, and that's gone up 5%. And again, that's at that 30% EBITDA margin that Matt spoke about. And equally importantly, you've got to do it, it's got to be sustainable long term, because that's a key characteristic of the business. And you see again, 2/3 of that revenue comes from either SaaS or subscription model. And that's basically, we collect that by monthly direct debit. So again, we grew that 1.2 million to 20 million pounds for the first half of the year. And that's just under 2/3 of the business overall. So we've got great visibility of our revenues. So, it's sometimes helpful to just distill that all down into what the 3 key value drivers of our performance is, with the number of parts underneath it. And just to see how that breaks out a bit more detail, we break down the revenue growth between organic and inorganic, and you can see the relative split there behind that overall revenue growth. So spend a bit of time on this. So this is a revenue stack slide that we present, and again, it just highlights the relative weighting of the quality of our revenue. So if you just looked at that right-hand side stack, you can see the bottom green section, that's the foundation layer of the business, and that's the 20 million or 65% of revenues that are recurring from either SaaS or subscriptions. And you can see the growth in the track record there. That middle section, the 11.2 million, so whilst that's not SaaS or subscription based, it's transactional, it is highly repeating. And I'll give you a couple of examples of what the bulk of that is. So we have a mortgage club. So basically we act for as for buying power for thousands of mortgage advisors, and we will go and speak to different high street lenders and get and negotiate better deals for them. So we've got 25 billion of lending from that panel of our businesses, the mortgage advisors that we support, and we take that buying power to the high street lenders and drive additional value, which ultimately gets passed through to end consumers, and we take a small percentage, 1 or 2 basis point of the mortgage procuration fees that are written. So that's transactional in nature. You only get paid once a mortgage is written and someone gets the keys to their house, locally speaking. But it's part of a membership base that's really sticky, so they tend to not go anywhere. And why wouldn't you be part of that lending panel when you get a better deal for your end consumer, quite frankly? And the other part of it's the de facto insurance ratings business. That's about 5 million of revenue a year, and that comes from, I'm sure you've all bought an insurance product and you've seen that it's de facto 4-star or 5-star rated. And those are an annual vintage, as it were. So you can't commit to 3 years worth of ratings revenue and do it on a subscription basis, because every year the criteria get refreshed, and every year you have to apply your product to have the particular de facto rating. Once that's in your marketing DNA, you tend to come back every year for it, and again you've got significant customer tenure in that product. So it's important to note that it's not an opinion-based rating. It's not 5 stars because we think it's a good product or the good service or claims history or whatever. It's a set of criteria that we publish in advance, and it's up to the insurers to build a product that meets that 5-star rating. So again, that's another example of how we've got some influence over building the best insurance products for end consumers. So it's factual as to whether it's a 5-star rating or not. There's no opinion based on it, which is why it's so valuable. So that's how our revenue stacks up. So, whereas 2/3 of it's SaaS and subscription based, really almost all of it has a great deal of visibility and is repeating in nature. How that breaks down into the 3 segments, so working left to right. So intermediary services, if you just have in your mind's eye, that's 3,500 IFA firms that pay us a monthly membership. And again, that's really sticky revenues, the 10 years, 7 years plus for the average member there. And that in and of itself is a great business, but what it does is it's highly attractive to those businesses that generate revenue in the middle column, the distribution channels. So in the distribution channels, we've got 3 revenue types, ostensibly. The first one is the share of the mortgage procuration fees, driven from those 3,500 members as part of the lending panel. The other part of it is the protection income that we get. So if someone takes out a mortgage, for example, they're highly likely to take out a life insurance product to go with it and to mitigate the risk against their mortgage not being paid. And again, similarly, we get an override on the commission of that policy being written. And thirdly, we've got a marketing and advertising revenue stream, because all the product manufacturers, we give them a much better ROI on the marketing spend, because we're able to distill which of those 3,500 members will be the best target audience for them and get a forum for them to present to that audience. You pick Aviva, for example. Someone from Aviva doesn't have to travel around the country visiting separate firms. We can get 100 IFAs on a Zoom call or a Teams call or in a hotel conference centre or what have you, and we get a revenue stream from the product manufacturers for space on stage, if you want to call it that. And then on the right, we've got fintech and research. That's essentially the de facto business, and that's got a couple of different variable revenue streams, one of which is the de facto Engage software product, and that's as an accountant, I use Excel every day, and as an IFA you would use de facto Engage every day. That's one of the tools of your trade, and that's the advice journey software to meeting and greeting a new prospective client all the way through to capturing their risk appetite and their age and their cash needs, and when need money and when they can accumulate and when the decumulation phase starts, etc. So that's the full life cycle of the investment journey, and that's software revenue, and then you've got the ratings revenue in there as well. So again, you can see growth across the board. The margin is slightly diluted, but it has to be diluted from 54 to 52%, and that's because of the integration of some of the acquired businesses that were at a break-even point, and we would expect that to accrete back up to being 54% plus over time. So from a P&L perspective, you can see growth across all the key metrics, but I think it's important to contextualise that growth as to where we are today. So basically, we present to you having invested £36 million on a vertically integrated supply chain, or a one-stop shop, so to speak. And it's now time, after that concerted period of M&A and investment, to focus on the core business and growing it. So we've given guidance that we'll reach the end of this financial year once all the acquisitions are completed, and we'll have about 36 million of gross debt, and that's about 1.3 to 1.4 tons of leverage. And that's the peak, and we'll start to delever from that point. And we've got a number of growth drivers, as Matt talked about, being Matrix 360, market penetration into the additional advisor firm that we bought, and enterprise license sales. And we forecast that we'll be debt-free again in FY27, FY28. And this, what this slide tells you, is we've gone through this strategy previously, because in 2019 we purchased the de facto business itself, and we focused inwards on maximising that opportunity. And you can see there that we completely delevered the business by the first half of 2023 into a gross cash position. And it was right then to start the capital deployment phase again and get the next step, which was that integrated one-stop shop. So you can basically cut and paste that and stick it to the right, and that will be the leverage, the deleveraging profile for the business as we focus on growing it organically hereafter. Yeah, each 6 months we like to give a bit more detail on just exactly what we've been investing in, because we have been in a significant investment phase. And again, this just walks the cash flow from left to right. So you can see, started off the year on the 1st of January with £12.7 million in the bank, generated circa 10 from operations in the first 6 months, borrowed 5, and that gave us just 28 million of financial resource from a sort of sources perspective. And the uses of it were 11 million into a variety of different investments in the period, 7.3 million in terms of capital transactions, dividends, and settlement of the LTIP. And then we've got some tax and some interest to service the debt. So you can see there, hopefully clearly, how we're investing, shareholders' funds for future growth. And again, that period of investment is curtailing now, and it's time to optimise the investments. Just another key metric for us is cash conversion. We use the green sort of bar there in the middle of the page as the benchmark internally from a division perspective. And the main reason for that is that's how well you're controlling your costs and your working capital and your investment into capitalised products, basically. The rest of it, tax, interest, lease payments, is frankly for me to worry about. So we measure the teams on their operating cash flow conversion, and you can see there again it's 101%. And we flow all the way down, including absolutely everything, to free cash flow. You see that conversion at 55% of EBITDA. And in the bottom right, you can see the investment for growth over the last 3 comparable periods. Again, that's peaked at 2.2 million, and that will start to fall over time. So in summary from me, hopefully you can see that it's been a strong financial performance across our key metrics. We continue to maintain that high quality revenue percentage in the core business. Again, strong cash generation, and hopefully you can see that we've been investing that for longer term and greater return, and deploying our financial resources judiciously, and that lets us put our dividend up to 1.2 pence per share at the half year stage, in line with our progressive policy. So, all systems going forward for monetizing the investments that we've made. and pass back to Matt.
Thank you, David, and thank you to everyone for watching. We've finished with plenty of time to spare, so very happy to take questions. There's some come through on the Q&A at the moment, so I'll read out the question and then either answer it myself or hand it over to my colleague, David. I think one question's coming from James, David, which you just ended on, so maybe elaborate on that a little bit more, which is, what is your longer term dividend policy?
Sure. So, I mean, ultimately, if you let me just quickly flip back to. So, if you look here in FY23, technically had a decision to make, James, in terms of, right, well, we've completely delevered the business. We've got de facto and Simply Biz. We've got the bookends of the service proposition for IFAs, and we could have reverted to a dividend stock there and treble the dividend and become an income story. So again, you've got the tenets of long-term sticky revenues, recurring cash flows, visibility of cash flows. But to be honest, the opportunity to build that one-stop shop was in front of us. That's what we plan to do. So over the next sort of 3 to 4 years, it will be small but progressive, and you'll see just similar steady growth. I think dividend payments an important hygiene factor for an AIM company. You've got different funds with different investment criteria. It's important that you hold the line on a certain level of growth. But 4 to 5 years' time, we'll delever the business again. We'll have a significantly higher level of profitability, and we'll revisit the dividend policy at that time. But for the next 3 to 4 years, where we're monetising these investments, it will be similar to what you see now. That's all right.
And David, while you had the same slide up and you're on a roll, let's go for a question in from Christopher, who said, how comfortable are you with the level of debt, and do you anticipate further borrowing to fund your growth?
Sure. So the current investment phase will see us reach gross debt of 36 million, and that's in the context of a revolving credit facility of 80 million. Now, that additional, so there's 2 things you can do there. You can, that's certainly all that we've planned to invest in to this point, certainly from an M&A perspective. So you could reduce the facility in size and save yourself the commitment fee, which is about 190,000 for that extra 40 million of headroom. But we think that it's a relatively small cost to maintain that level of liquidity should anything else present itself. That being said, that the guidance that we've given in the market and the outlook section of the half-year RNS is that we will end 24 about 1.3 to 1.4 tons of leverage, 36 million of gross debt, and delever thereafter, hopefully seeing it as pay the final bit of that debt off in FY27, Q1 28. So happy with the level of debt, happy with the level of leverage. The recurring cash flow characteristics of the business mean we delever the business quite quickly thereafter. But it's important to have that flexibility and credibility, frankly, if something comes along that we would like in the mortgage space, for example, that we're not completely reliant on an equity raise or a refinance. We've got some dry powder. A technical point on that, as I continue, is the covenants in the debt facility allow us to go up to 3 tons of leverage. So in order to deploy the rest of the facility, the EBITDA that we would have to acquire would mean that it would be value accretive, because we couldn't go and spend another 30 million on businesses that are breaking even. Basically, that just couldn't happen structurally in the facility. So we've got dry powder to make a strategic, large, immediately accretive investment. We've not got the dry powder to continue to make small bolt-on investments that we need to drive synergies out of. We've kind of done that now.
Thank you, David. We've had 2 questions in from John. I'll answer both of these, and the first one of those is, Fintel completed 4 acquisitions during H1. What synergies have you already realised from these acquisitions, and how long do you expect the integration process to take before full benefits are delivered? So great question, John, and I think there's a number of parts to that answer. So first and foremost, the businesses that we've acquired, in the main, we are comfortable that if they continue along the path that they were when we acquired them, they will continue to generate revenue growth and earnings growth. So they're strong businesses in their own right, with quality propositions or products out there in the marketplace, used by in the main thousands of advisors, and they are growing well themselves. So an example of that is Vouch4. If we don't do anything at all with the integration of Vouch4, that will continue to run as a fantastic business with a great product that has absolute growing demand at the moment because of primarily Consumer Duty. So those businesses we've acquired, we think, run well individually and without too much interference. However, we are aware that we can generate integration synergies in a number of ways. So first and foremost, there is the cost synergy to look at. So where can we centralize finance, HR, and some of the operations of those businesses, leaving them free to deal with their clients in the way they want to, but being able to operate at a higher margin. So that's one area. The second area is where can we use the distribution that we have within the group to generate real revenue synergies. So again, under the example of Vouch4, it's opening up that service to the distribution group that we support through Simply Biz and 360, and indeed Compliance First. So there's cost synergies, there's revenue synergies, and then the other big synergy is on bringing those businesses together to form the connected platform that we discussed on one of the earlier slides of the presentation. And in terms of the work that we've done so far, we have created integrations via two-way API integrations to seamlessly flow data between the systems. If we prove that that's successful and we win some large-scale contracts, which I'm hoping we will do relatively shortly, then we will go on to look at synergies around UX and UI. But for now, we're concentrating on the data flow, on the operational synergies, and on the revenue synergies through distribution. So I think it's a journey of which there are multiple steps and multiple stages. We are on stage one of those because we've only acquired the businesses relatively recently, but we believe all of those businesses we've acquired have the ability to generate synergies in all three ways. So hopefully that's answered the question for you. The second part of the question is you say also you've increased investment into the Matrix 360 platform. Can you elaborate on the specific developments and enhancements you're making? Absolutely. So Matrix 360 will go ultimately from providing one data set, which is product data, to 7 or 8 data sets into the general insurance market, the asset management market, and banking. At the moment, we've concentrated on the development of one of those product sets, which we believe is the most important fundamental first step, which is pricing data. So we're bringing pricing data into the product data that we have and concentrating primarily on the GI market. And the reason we're concentrating on that market is because it's the most obvious in terms of it's the largest customer that we have within the current Matrix product. So we've got one development or one additional data set out of 7, and we are concentrating on one of the 3 markets. As we grow the continued development of Matrix, the other data sets will come in more rapidly than the first because we had to re-engineer the platform at the first stage of development and re-engineer the data architecture. So the next 6 data points will come in more rapidly than the first. They will cost less to bring in, and then we will go after the other 2 markets of GI and banking as well. So that's the sort of development journey for Matrix 360, if you like. I think that now completes John's 2-part question and all of the questions actually that I have on the system at the moment. So if anyone does have any more questions to ask, please feel free to do so. We'll give it another couple of minutes, and if nothing else comes in, then we'll deliver a quick summary on the business and leave you to crack on with your day. Okay, there are
Matt,
no more questions.
yeah,
Sorry.
Matt, David, what I was going to say is I was just going to jump in and thank you for answering the questions that you have already. If any further questions come through in the feedback, we'll provide them to you and you can provide written responses where it's appropriate to do so. But what I'll do just before redirecting investors to provide you with their feedback, Matt, if I could just ask you for a few closing comments, that'd be great.
Absolutely, and thank you to everyone for taking the time to watch the presentation and also for submitting questions. I think in summary, it's been a really good first half of 2024. We have delivered the financial results that we set out to deliver, and more importantly than that, we have invested into and established a platform for growth over the next 5 years. We've acquired some great businesses over the last 18 months. We've made 2 additional investments into core software businesses, and we are set for growth. Our focus is on major enterprise wins with our connected platform, on increasing the revenue that we generate from Matrix 360, and on developing the services that we offer out to the customers of 360. So we feel very well positioned for future growth. And thank you very much for watching and taking the time out of your diaries to listen to David and I. Thank you.
Matt, David, thank you once again for updating investors today. Could I please ask investors not to close this session, as you know, be automatically redirected to provide your feedback and all the management team can better understand your views and expectations. This may take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of FINTEL PLC, we'd like to thank you for attending today's presentation and good afternoon to you all.